5-minute HEIKEN ASHI Scalping Strategy. The best scalping strategy for beginners that no one ever told you. This video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, commodities, or any financial markets and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high-probability trade using the HEIKEN ASHI indicator. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Scalping is the fastest way to make money in the forex and stocks market. There are no other methods that can increase the capital of a trader more effectively. So, in this video, we'll talk about the 5-minute scalping trading method. Then, we'll cover every inch of detail about the strategy. This highly effective scalping strategy is very easy to understand and can be applied immediately because it is universal and works in all financial markets. It can be applied in very short time frame, as in the 1-minute chart, as well as on higher time frames. What is the scalping trading strategy? Whether you're a complete beginner or an experienced trader, you will likely have seen the term scalping being discussed. Scalping is essentially a means to trade certain currencies using real-time analysis, with the intention of making a small profit by holding a position for a short period. It's one of the most popular trading techniques, and with Trader DNA, you can learn how to use a scalping strategy to your advantage while trading. Scalping. How to benefit. A 1-minute or 5-minute scalping strategy is a great technique for beginners to implement. It involves opening a position, gaining some pips, and then closing the position shortly afterwards. It's widely regarded by professional traders as one of the best trading strategies, and it's also one of the easiest to master. The main aspect of scalping is quantity. To this end, it's not uncommon for most traders to place more than 100 scalping trades each day. To benefit from a scalping strategy, it's important to choose the best broker for small spreads and commission. Scalping trading tips. Successful scalping relies on you being passionate about what you're doing and willing to invest time into monitoring the markets and developing the best strategy. This is because you'll need to wait for the market conditions to give you signals to decide whether to go short or long. Most scalping traders work on small timescales such as 15-minute, 5-minute and 1-minute charts when day trading. To enjoy returns from scalping, you'll need to develop the skills to be able to quickly execute orders and close open positions. Gaining an understanding of when to make a move whilst day trading is crucial too. Choosing the right market is also important. 5-minute scalping strategy pros and cons. The beauty of a short scalping strategy is that there is less exposure to risk. Brief exposure to the forex market and stock market reduces the chances of running into unexpected events, like losing money rapidly. Small profits and movements are easier to achieve, as a larger supply-demand imbalance is required before large price changes occur. The logic behind the 1-minute scalping strategy is that small moves happen much more frequently than big ones during a trading session. Even when the markets are relatively quiet and stable, scalpers can make money from small moves. However, large deposits are needed to make decent returns on short scalps. A 5-minute scalper will also need good instincts, mental arithmetic and fast reflexes. Scalping can also be time-consuming and stressful, so consider all your options and skill sets before setting your sights on a 5-minute scalping spree. The best 5-minute scalping trading strategy. There's no ultimate rule regarding the best trading strategy. The best trading system to employ will depend on the current market conditions. Of course, keeping your investment safe is important, and to do this you'll have to make use of stop losses. Stop losses should be arranged around 2 or 3 pips below the last low point of a swing. It's not uncommon to gain 6 or 12 pips on a trade. Aim for this and you'll be on the way to success. Before you invest any real funds, give a try to a free demo account that allows you to practice with virtual market. This way, you can hone your skills before employing your scalping strategy for real. Start small and scalp lightly. In the world of scalping or scalp trading, money management is incredibly important. If you want to become a scalper and enter the realm of scalp trades, you should be aware that you should never invest more than you can afford to lose. While scalping can involve performing hundreds of trades in a single day, each of these trades should be small enough to not damage your existing portfolio in the event of a loss. Many professional traders abide by a 1% rule when seeking successful trades. This means they do not exceed 1% of their overall funds in a single trade. However, even this could be too much if you're using the scalping method. 100 trades in a day at 1% each is effectively all of your funds, and you might find yourself losing money rapidly. So, trade wisely. 5-minute HEIKEN ASHI Scalping Strategy. HEIKEN ASHI Scalping Strategy are some interesting features, but that can soften the price movement, allow us to design a series of systems and strategies that can be implemented well in different time frames and all financial markets. And now, what is the HEIKEN ASHI candlestick? The HEIKEN ASHI is a Japanese candlestick-based technical trading tool that uses candlestick charts to represent and visualize market price data. It is used to identify market trend signals and forecast price movements. The HEIKEN ASHI technique averages price data to create a Japanese candlestick chart that filters out market noise. The absence of market noise results in a clear illustration of market trends and direction, which helps determine potential price movements. The trading technique assists traders in identifying when they should hold on to a trade, pause a trade, or identify if a reversal is about to occur. Traders can adjust their positions accordingly, that is, either avoid making losses or lock in a profit on the chosen position. HEIKEN ASHI charts, developed by Munehisa Hama in the 1700s, share some characteristics with standard candlestick charts, but differ based on the values used to create each candle. Instead of using the open, high, low, and close like standard candlestick charts, the HEIKEN ASHI technique uses a modified formula based on 2-period averages. This gives the chart a smoother appearance, making it easier to spot trends and reversals, but also obscures gaps and some price data. The difference between HEIKEN ASHI and traditional candlesticks. The main difference between the traditional candlestick chart and the HEIKEN ASHI chart is that the HEIKEN ASHI candles provide a smooth averaged version of price action in a chart, whereas traditional candlesticks include the noise of major price changes. Regular candlesticks present a raw version of the open, close, high and low prices of a particular bar, and HEIKEN ASHI candles present an averaged version that is dependent on always having the previous candle's data to calculate the current one. The chart on the left is the traditional Japanese candlestick chart, and the chart on the right is the HEIKEN ASHI chart. As you can see from the chart on the right, directional moves are smoothed out in a way absent from the left chart. Candles on traditional Japanese candlestick charts frequently change from blue to red, or up or down, which can make them difficult to interpret. On the other hand, candles on the HEIKEN ASHI chart display more consecutive colored candles, helping traders to identify past price movements more easily. You'll notice that HEIKEN ASHI charts have a tendency for its candles to stay blue during an uptrend and stay red during a downtrend. This is in contrast to traditional Japanese candlesticks that alternate color, even if the price is moving strongly in one direction. You can clearly see that the HEIKEN ASHI chart is much smoother looking in terms of price action. This is why many traders prefer to use the HEIKEN ASHI candles, since it reduces the noise on the chart and allows them to analyze trends more clearly. What makes HEIKEN ASHI different from a traditional Japanese candlestick chart is how the price is displayed in terms of the open and the close. If you look closely at the HEIKEN ASHI chart, you'll notice that each of the HEIKEN ASHI candlesticks starts from the middle of the candlestick before it, and not from the level where the previous candlestick had closed. HEIKEN ASHI candlesticks act this way due to the way they are calculated. If you're interested, here's the calculation. HEIKEN ASHI close equals average of open, high, low, close. HEIKEN ASHI open equals midpoint of previous HEIKEN ASHI bar. HEIKEN ASHI high equals highest of high, HEIKEN ASHI close, HEIKEN ASHI open. HEIKEN ASHI low equals lowest of low, HEIKEN ASHI close, HEIKEN ASHI open. By the way, please don't bother to memorize this formula. And don't even think about trying to understand why it's calculated this way. It will not help you be more profitable or help you become profitable at all. Just understand that it's meant to help you identify trends better in the market. Also, don't mistake the HEIKEN ASHI bars as a trading system because it's not. If you go long whenever you see a bullish bar or go short whenever you see a bearish bar, then you will go broke very quickly. Like the candlestick bars, it's just giving you information on the market. HEIKEN ASHI price action patterns. With candlestick bars, you have many different types of price action patterns. You have the doji, gravestone doji, and the dragonfly doji. You have the pin bars. You have the engulfing candlesticks. And the list goes on and on. There are literally tons and tons of candlestick patterns. But with the HEIKEN ASHI bars, I've categorized them to just 3 main types of price action patterns. First, bullish HEIKEN ASHI bars. With the bullish HEIKEN ASHI bars, you will notice that there's only a wick at the top of the bar, but there's no wick at the bottom. As long as this is an up bar with no wick at the bottom, we consider this a bullish signal. Second, bearish HEIKEN ASHI bars. The bearish HEIKEN ASHI bars are simply the opposite of bullish HEIKEN ASHI bars. They have a wick at the bottom, but not wick at the top. As long as this is a down bar with no wick at the top, we will consider this a bearish signal. Third, indecision HEIKEN ASHI bars. To simplify the HEIKEN ASHI bars, I've categorized all bars that have wicks at the top and bottom of the bars as an indecision HEIKEN ASHI bar. So regardless of whether the bar color is bullish or bearish, as long as there are wicks on both sides, we will consider this an indecision HEIKEN ASHI bar. HEIKEN ASHI scalping strategy configuration. First, HEIKEN ASHI candles. Second, Trend-CCI. Third, 50-period EMA. Important details before trading. First, HEIKEN ASHI with Trend-CCI strategy is a trend momentum strategy. Second, the 50-period EMA and Trend-CCI histogram always give signals to buy or sell, but do not take entries. Third, the Trend-CCI histogram and the Trend-CCI line have the same location. Fourth, use HEIKEN ASHI to spot trading opportunities. Fifth, use 5-minute time frame chart or higher. Sixth, the trading strategy can be extended to larger time frame chart and all financial markets. Buy entry rules. First, the HEIKEN ASHI candle closes above the 50-period EMA. Second, the Trend-CCI histogram and Trend-CCI line above the zero level. Third, waiting for a retest will make you a better trader. So, in this third step, you have to wait for price retracement above the 50-period EMA. Fourth, the entry is confirmed when the HEIKEN ASHI candle turned bullish after the retracement. Fifth, the stop loss is placed in the minimum recent low. Sixth, exit trade when the HEIKEN ASHI candles change from blue to red. Sell entry rules. First, the HEIKEN ASHI candle closes below the 50-period EMA. Second, the Trend-CCI histogram and Trend-CCI line below the zero level. Third, once again, waiting for a retest will make you a better trader. So, in this third step, you have to wait for price retracement below the 50-period EMA. Fourth, the entry is confirmed when the HEIKEN ASHI candle turned bearish after the retracement. Fifth, the stop loss is placed in the maximum recent high. Sixth, exit trade when the HEIKEN ASHI candles change from red to blue. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of how to trade the market using the combination of Trend-CCI and HEIKEN ASHI candles to fully understand this wonderful strategy and to make the most out of it. This highly effective scalping strategy is very easy to understand and can be applied immediately because it is universal and works in all financial markets. It can be applied in very short time frame, as in the 1-minute chart, 5-minute chart, as well as on higher time frames. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.